Andy, what's one thing that you would recommend people watch out for, and why would it be important?
The most important one to me and maybe the most impactful, I think it's inventory right now. You're seeing this push-pull behavior between buyers and sellers out there in the market, and it's got us in this finger trap from a price perspective where you start to see the market soften up, you start to see inventory grow, and then sellers in some of these markets have said, no thanks, we're just going to pull our homes off and we're just not willing to accept a lower price than we're comfortable with for our home. So it's really interesting to watch that inventory dynamic because, again, inventory has been the key to price in recent months and recent years.
Welcome to Keys to Real Estate, the podcast where we explore the forces shaping housing, lending, and the entire real estate sector. And we talk to the people behind the headlines. I'm your host, Mary Schuster. Each month, the Mortgage Monitor report offers one of the most data-rich looks into the U.S. housing and mortgage markets, from delinquencies and foreclosures to rates, originations, affordability, and equity. August's report is hot off the presses, and so today we're talking with Andy Walden, who's head of mortgage and housing market research for Intercontinental Exchange at ICE Mortgage Technology. Andy and his team are behind the Mortgage Monitor reports, and he's here to help us understand what's happening now and where the market could be headed. Andy's going to break it all down for us, so let's get underway. The presenting sponsor for this season of Keys to Real Estate is Closing Lock. Working in title, do you ever feel like you've got a target on your back? Every year, $2 trillion moves in and out of escrow accounts in the United States. Fraudsters are watching and waiting for one wrong click, one unsecured email, just one oversight. And then just like that, your client's life savings are gone. That's where Closing Lock comes in. Closing Lock provides title companies a secure, all-in-one platform to prevent fraud, protect funds, and streamline closings. Over 1 million home sales have closed safely without incident in Closing Lock. The fraudsters only have to be right once. Title companies have to be right every time. Closing Lock has your back. Visit closinglock.com today to learn more. Andy Walden, welcome to Keys to Real Estate. We're thrilled to have you here.
Appreciate you having me. Thank you.
Well, you have been very busy. You and your group are behind the Mortgage Monitor report. And so in case we have a few in the audience who aren't yet familiar with the product, how long has ICE been putting it out? And just tell us a little bit about it, if you would.
Yeah, it goes back a ways. So the Mortgage Monitor itself predates the ICE acquisition of Black Knight. So on the Black Knight side, the Mortgage Monitor has been in existence for 15 plus years out there in the market. It started really as a chart book for delinquency, prepayment, foreclosure, origination trends. And then as Black Knight grew, and now with the merger of ICE and Black Knight, with just significant growth in the number of data sets that we have available to us, it's really ballooned. So now not only are we looking at mortgage performance and origination, but we're getting into the housing market space, supply, demand, price trends, all of the goodies there, public records data, climate data, property insurance, just going on down the line of all the things at our fingertips. And so we've really broadened it out and have a nice library of things to look at every month and kind of bring to light some of the emerging trends out there that everybody's interested in.
Well, and I feel it's an essential tool for helping understand the market, that deep dive that you mentioned. And we're going to go into a lot of that today. So thank you for that. And August report is out. It's pretty fresh. It's got some important headlines for people who work in the industry. What were some of the biggest takeaways in it?
A lot of good content there in the August report. One of them is that lending rebounded a little bit. It kind of quietly had its best quarter from both a volume and a loan count perspective that we've seen in nearly 3 years out there in the market. But lenders and servicers are still really struggling to retain those refinancing borrowers. And so we went into the weeds there in terms of what retention rates look like, what volumes look like, who, what, when, where, why people are refinancing and transacting in today's market to help folks target in their marketing efforts. A lot around mortgage performance and some of the shifts that we've seen recently. And then got into the weeds of the housing market, right? What are we seeing in terms of affordability, inventory, price shifts, demand out there in the market, and some of those local home price dynamics that have really started to inflect here throughout 2025?
Well, great. It does give a wonderful, both broad and deep picture of what's going on right now. And to your point, it's not a normal market. It's certainly not a market that a lot of us are used to. And so what's starting to change, what's going on, what are the deeper points of analysis underneath that, I just think are critical for people, especially in a very different time than a lot of us have experienced before. So let's start looking at, if we can, the mortgage performance and delinquencies. The report mentions that June, I think, saw a 15 basis points increase in delinquencies. And so I'd love for you to talk about that and tell people what they should understand with regard to that overall increase.
Sure. Yeah. And if we just zoom out and take a big picture look at what's going on with mortgage performance, delinquencies are still pretty darn low from a historical perspective, right? We're below where we entered the COVID pandemic. We're well below long run averages in terms of delinquency rates. And so overall, mortgage performance is really strong. Right? And it's better than what you're seeing among credit card debt, student loan debt, auto debt. So folks are still relatively resilient out there. But we have seen that market kind of bottom out. So we reached the trough over the last couple of years, and you're starting to see mortgage delinquency rates trend a little bit higher. What we're really focused on is some of those minute movements and where inside the market are we seeing those shift for signs of bigger issues, right? Mm-hmm. So when we start to dig into the weeds there a little bit, you mentioned that May to June jump, 15 basis points or 0.15% increase in that delinquency rate. That's a large increase when you look historically at what you traditionally see from May to June. And so that catches your eyes a little bit. The other area that we see is FHA delinquencies are starting to rise. There's been a lot of conversations around that. Are they the canary in the coal mine? Are they the focal point going forward? Are you seeing any contagion outside of FHA to other areas of the market? So that's really what we're seeing. Again, broadly, performance is pretty strong, but given tariff dynamics and resumption of student loan debt collections and gradually rising unemployment and softer labor market dynamics in recent months, all of those things combined cause you to be a little bit more focused in on mortgage performance and any shifts that you're starting to see that could progress into the future.
Yeah, the FHA and VA delinquency rates were noteworthy to me too. Mm-hmm. I'm like everybody else, probably waiting to see are those signaling something change, or it sounds like we might not know yet, right?
Yeah, I mean, they're certainly moving up, right? And that's to be expected. If you look at lending activity in recent years, that's the one area of the market that if you're a more moderate credit score borrower and you need a low down payment mortgage and you're more on the first-time home buyer end of the spectrum, it's one of the few areas that you've been able to go out there and get a mortgage over the last better part of 15 years since the last financial crisis, right? Back then it was the private label security world and you could get those loans anywhere and they were packaged and securitized. That's not the case in the past decade and a half. So it's not overly surprising to see delinquency rates rising in that FHA space. They are the highest that they've been. It was the highest June number we'd seen since 2013. So they're kind of in this middle ground between the lows that we saw in the 20 teens and where we were in the early 2000s. We're kind of halfway in between those two, and they're modestly rising. And so you are seeing some upward movement there. But again, that's somewhat to be expected given the dynamics. I think, again, to the point we were making earlier, the question is, do you see contagion outside of that FHA space? Is that an early indicator? Is that a canary in the coal mine for shifts into GSE delinquency rates or bank-held portfolio loan delinquency rates? And we haven't seen any of that emerge yet, right? So eyes are still there, but not a whole lot of emergence. It's really kind of concentrated into this FHA space. And then beyond that, do these FHA loans have any contagion of foreclosure activity that could cause any of that distressed sale activity that we saw when you look back into the 07 through 12 era as well? You're not seeing a whole lot. I mean, there's some movement in foreclosures, but not anything overly concerning. So right now, it's again, really concentrated in that FHA space. You're seeing them rise, but we haven't seen that contagion yet that you'd be more concerned about.
So it sounds like you're watching. It sounds like maybe the September and October reports could be very interesting on that regard too, to just see, is it still just, or is it starting to look more like a signal? So that's a technical term, Andy. I don't know.
Yeah, we use that one all the time.
Yeah. Good. Speaking of foreclosures, the foreclosure starts are at some of the lowest levels in decades. What's keeping them there?
I mean, there's a wide array of reasons behind that, right? High quality lending in recent years, a still pretty resilient economy. We've learned a lot about loss mitigation over the last 15 years, and you have some pretty robust programs out there. So if you look at kind of the great financial crisis era, a lot of modification activity that was taking place. We learned what modification programs worked, which ones didn't. And then we moved into a very different environment following COVID-19, where it was heavy forbearance and short-term loss of income focus. Fortunately or unfortunately for the industry, we've been through several ebbs and flows where those policies have been tuned, and they're still fairly expansive as we head into the tail end of this year. And then equity also remains strong, right? So if you go back to 2010, 11, 12, there was a lot of cash for keys or folks walking away from their homes when troubles ensued. Right now, the average home in the US is 55% equity, 45% debt. So folks have a strong incentive to continue to make their mortgage payments, to stay with that home and not lose it to foreclosure. So again, a lot of different reasons behind what we're seeing, but the net result is still very low foreclosure rates, trending up modestly from where we were at the same time last year, but still below where we were in 2019 prior to the impact of the pandemic.
Well, we had Mark Calabria on the pod a few months ago, and he would be very happy to hear you cite that forbearance in lieu of foreclosure as part of the elements that worked, because it was a bit of a novel concept. It's not a novel concept, but it hadn't been necessarily tried large scale. And he was confident in its outcomes. And it sounds like you are echoing that.
Yep.
I'm glad we can learn these things, right? All right. Well, let's look at interest rates and refinances and originations, because eventually I want to get to, you've got some real interesting statistics on equity that's sitting out there. And so I'm trying to make our way to that, because that equity is awfully appealing to some folks out there. But so let's talk about that. How much total equity are homeowners sitting on? And then I'd like to compare that with what's their existing tappable equities out there. And for those that don't know the difference, maybe a short definition.
Yeah. So we're really focused in on mortgage holders in the US, right? And their equity positions, both from a risk and a lending opportunity perspective. And so what we do is we analyze all of the mortgage properties at the loan level. So we're looking at what was your unpaid balance at origination? What was your original property value? How has that property value changed over time? And what have you done to pay down your debt? And then have you borrowed any against that equity? Have you added a second lien? So we're taking all of those things into consideration with our analysis and running it at the loan level. And when we do all of that and we look at it entering the third quarter of this year, so as of the end of June, what we see is that folks are sitting on close to $18 trillion of equity, right? It hit an all-time high in the second quarter of this year. When we look at what's called tappable equity, we're then taking a haircut off of that, right? So again, doing it at the loan level, but looking at how much could borrowers tap into before they hit an 80% loan to value limit, or put a different way, how much could they borrow against while still keeping a 20% equity cushion in their home? So that's what tappable equity is. If you're a lender out there, you could call that lendable equity as well. It would be the same thing. About $11.5 trillion of lendable equity also hit a record high in the second quarter of this year. Now, with the housing market beginning to shift a little bit, right, and cool off, we did see some signs of that beginning to plateau in the second quarter of this year. So that tappable and overall equity trailed off a little bit from May to June. So maybe some signs that you're starting to see, again, that plateau and maybe come down, especially in certain areas across the country where home prices are softening more. But a lot of equity out there for homeowners. Again, a lot of equity out there to lend against or borrow against in today's market as well.
All right. So given that as sort of our foundation, a lot of us that work in industry believe that because most of those owners who are sitting in that kind of equity have such low rates on their first mortgage that it's difficult or impossible to get them to tap that equity. So I'm wondering, what information do you have about those borrowers? What's their willingness? Do we need to come up with some exotic products to go get them? What are those homeowners thinking?
It's a good question, right? So you're absolutely right that it's held by lower interest rate homeowners. So the stat is 3/4 of that tappable equity is held by folks with interest rates below 4.5%. So they are somewhat locked in on those lower existing rates. And you have heard more conversations about exotic products, equity sharing products, and things like that, where you could borrow against equity without taking on more debt or taking on a monthly payment. And so you're certainly hearing continued conversations around that. Even beyond that, right? If we look at traditional equity withdrawal, it's still constrained, right? There's not as much per available dollar of borrowing than you traditionally see out there. But if you look at second lien lending, right? 3 months ago, we were reporting on Q1, and we saw the strongest Q1 for second lien loan and line of credit lending that we've seen since 2007. And so it's still not anywhere near the 2004, 5, 6, 7 levels, but you are seeing a little bit of increased participation and withdrawal there. Cash outs in the second quarter of this year hit their strongest level in nearly 3 years. So you're seeing a little bit of increased willingness as rates ease off of what have been recent highs for folks to go out there and tap into equity. The other thing that I would mention there is when you look at the conversations around the Federal Reserve and interest rate easing, right? I feel like we read a new article on that every single day. The most direct impact that Fed funds rate has is on your home equity lines of credit because they're variable rates and they're tied to those short-term interest rates. So you see almost a direct correlation between what the Fed does and when the Fed eases and the rates that are being offered on second lien home equity lines of credit. So to put that into practical reality, a year and a half ago, the average interest rate on a second lien HELOC was 10%. Right now, it's dipping slightly below 7.5%. And then if you look at what's being priced in for the Fed for the next year or so, that suggests that second lien HELOC rates could dip down into the 6.5% range, right? So still a little bit on the high end from an affordability perspective and the cost to withdrawal equity, but it's becoming more attractive as the Fed eases off those interest rates and as those HELOC interest rates start to ease a little bit lower as well.
It makes complete sense. It would make sense that a contributing factor would be the length of time that they've been sort of locked in, not moving homes. And so the longer they sit, the more appraisal value they get. It would make sense that more would start to consider or actually execute on a home equity line than maybe they would have when margins were a little tighter.
Yep. No, that's exactly right. And you see that, especially we did some cash out analysis this year and looked at when did folks take out their prior mortgage that are pulling cash out refis right now. It's a third pre-COVID pandemic, so a third 2019 and earlier, a third that actually took out their mortgages in 2020 to 22 that are locked into record low rates are giving those up for cash out in their home, and a third that are your 2023, 24, 25 originators that maybe they're moving laterally for their new rate, or maybe they're getting a slight rate improvement, but they're also able to pull some of that equity that they've gained over the last couple of years. And so it's really an interesting mix between the two.
I think that's such an important point to really emphasize because, again, the thought process is, oh, they won't want to refinance. They're sitting on those historic low rates, but you're saying they're starting to look past those rates in order to get to that equity.
Yeah, some will, right? And it tends to be folks that have lower balances. So when you look at these cash out refinancers, at least in the second quarter of this year, the average first lien loan amount was sub $200,000 on average. So it's folks that, the higher your first lien loan amount is, the more tied you are to that record low interest rate. If you have a lower balance, some of those folks are willing to give that up, right? So I'll withdraw $94,000 of equity. I'll get it at a little bit better rate than I would get on a second lien. And they're willing to take that blended average by just giving up that low first lien interest rate on a lower balance. When you get into folks that have higher balances, so get into your expensive city centers and places like that, they're more tied to those lower interest rates they have on their first loan. So those are the folks that would lean more into a second lien line of credit to withdraw that equity so that they can keep their very low first lien interest rate. So that behavior really depends on, one, how much they need that equity, but their individual situation too. How much do they have in their first lien balance? What's the rate on that? How much equity are they going to borrow? They may not realize it, but they're doing a calculation on the blended average of what ultimate rate am I going to get across the board? And when I look at this total debt consolidation, what's my overall mortgage payment? And so that's dictating whether folks are taking a cash out refinance or a home equity line of credit.
That's a very smart conversation to be having with prospective borrowers. Obviously, the purchase market is still dominant in lending, such as it is. And folks have change their staffing levels at this point to be commensurate with it. People will hang on as long as they can. We have had some reductions in staffing levels. And so everybody that I talk to in the market currently is asking the same question. They're like, is there going to be a little refi boom or boomlet coming? Because they don't want to get caught off guard with half the staff that they need. So I know you're not in the prediction business, but do you have just some thoughts for those?
I'll hedge here a little bit, right?
Okay.
Obviously, interest rate dependent. Where interest rates go is going to dictate what those volumes are. But that's where the scenario type analysis come in of if then, right? If rates are this, here's your volumes. And that's somewhat easy to do, right? When you look at interest rate expectations and then you kind of run those interest rates up against what we're seeing in terms of the active mortgage universe makeup. So if you do something like that, right, and let's find ourselves a baseline. If we look at ICE futures data, right, so a lot of folks maybe aren't aware that 30-year mortgage rate futures trade in the futures market, just like pork bellies or corn or soybeans, right? It's used for hedging origination pipelines. So when you look at those 30-year mortgage rate futures, and you can look at them out 6 months in that ICE data set, basically, if you look at those prices and imply what that means for 30-year rate expectations, they're trading at prices that imply the market's expecting 6.3, 6.4% 30-year mortgage rates at the tail end of this year. Will that be right? Who knows, right? It's not necessarily more accurate than an economist forecast is, but it gives you a baseline of where folks are placing their bets right now and placing their money. So if we use that as a baseline, 6.3, 6.4% rates at the tail end of this year, what would that mean for the number of folks that are in the money for a refinance? Well, as we stand here right now, mortgage rates, call them 6.65% roughly today, about 2.0 million folks that could benefit by 75 basis points in a refinance. It's a fancy way of saying you could drop your interest rate by 0.75% through a refinance. So we're at about 2 million right now. If you got into that 6.3, 6.4 range, you're at roughly 3 million, right? So some modest improvement is roughly the baseline expectation for refinance activity later this year. What becomes interesting is if mortgage rates get down into the low sixes, that's where you start to see a little bit more activity. And the reason behind that is the most popular interest rate that's been taken out over the last few years, 6.875%. Why? Because nobody wants to look at a 7 on the front of their mortgage bill every month. They feel so much better if it says 6, even if it says 6.875. So you have folks that have bought down interest rates, and you have this chunk of mortgage holders sitting right there at 6.875. Then look at what interest rate it takes to incentivize them to refinance. It takes a rate in the low sixes, right? And once you get into that low 6% range, then you have the opportunity to relatively cheaply buy down, and then you get the pleasure of looking at a 5 in the front of your mortgage payment instead of a 6, right? So that's where a little bit more potential and activity sits. In each eighth of a point improvement in 30-year rates, once you get below 6.25, get down to 6 1/8 and 6, you start to see twice the volume come into the market per eighth of a point improvement in 30-year rates. So modest improvement if we see mortgage rates move from where they are down into the mid to slightly below mid 6% range. A little bit more meaningful volume comes when you get into the very low sixes and cross that 6% threshold, because then folks start to see a 5 in front of a loan, and it starts to entice a little bit more volume.
Okay, good. That's a great rule of thumb way to help people gauge what might be happening and so that they can be proactive with it. Thank you for that. That's great. Yeah. I'd like to move a little bit, if we could, over to the housing purchase market and affordability, because it appears like what's going on out there. The reason I ask is some things are not exactly intuitive or what you'd expect, like where we've had some inventory shortage easing has been in some of the hyper popular pandemic area like what's going on?
Yeah, and it really depends on where you look, which is why it's confusing to look at those housing market numbers, right? So there is a wide array of trends going on across the country. You've got areas like Florida, or now moving into Denver, where you have 50, 60, 70, 80% more homes available for sale than you averaged from 2017 to 2019. Arguably moving into surplus territory, not arguably, moving into surplus territory in some of those markets. And those are the areas where you're starting to see home price dynamics soften up. I think we've all heard about the Texas and Florida dynamics and prices easing in those particular areas. You're also seeing that move out west now.
Las Vegas, I heard the other day. Yeah.
Yeah, getting into places like Colorado and California is starting to emerge as well. Let me touch on the opposite. The opposite is the Northeast, right? Where you're still 50, 60, 70% short in some areas in terms of the number of homes you should have, is keeping prices firmer. So to me, the inventory dynamic is the most interesting trend line, because that has been the pathway to home affordability, if you will, right? Those areas that haven't seen inventory return are stuck in deep deficits. You continue to see firm home prices and then push higher and continue to have affordability challenges, regardless of what's going on the demand side and the interest rate side. Mm-hmm. It's the areas where you've started to see inventory return that have started to see some price softening, giving buyers a little bit more leeway in those areas. And you've seen more meaningful affordability improvement in those areas of the country as well.
All right. That makes good sense. So home price growth is slowing overall, but you mentioned the West generally and generally the Northeast. Is there a market or a tier that surprised you the most in there?
I wouldn't say surprised me, but the one that I think is maybe the most impactful is California, right? We're moving out of, Florida's impactful too, large populations down there in Florida, very meaningful state for the mortgage and housing markets. California may be a number one, right? In terms of the number of mortgages out there, total outstanding debt, impact on the overall market at large. And we've started to see these dynamics that we were seeing in Texas and Florida ease out there a little bit as well. So the majority of California markets are now seeing prices down from the same time last year. The majority of California markets are now back to or above 2017, 18, 19 levels of inventory. And so you're starting to see prices there shift a little bit. Southern California is also where you have the least affordable housing nationwide, and probably arguably needs the most help from an inventory and a price perspective as well, and just a simple affordability perspective. That's one that jumps out to me that I'm watching really closely. How is what's been transpiring in the South moving out west, and with a keen eye on California just because of the number of loans out there. The other one that is interesting to me is from a price tier perspective, and it's the lower end of the market, right? The bottom 20% of homes by price. Very different trend lines in that bottom 20% depending on where you look. In the areas where prices remain firm, Midwest, Northeast, typically that bottom 20% is leading the way, right? You're seeing some of the firmest home price growth in that low end of the market. When you get into the areas where the market is soft, Texas, Florida, out west, it's typically the low end of the market that's the softest right now. So very interesting differences on the low end of the market, depending on what all of these other factors are and what's going on from a broader price dynamic.
All right. Well, I noticed that July was ranked among the 10 least affordable months in 38 years for housing. You talked about a lot of why that is, but I'll ask, what do you think our affordability outlook is for next year?
I think it's modest improvement would be the baseline expectation, right? You go back to the futures implied mortgage rates and some perhaps modest improvement in mortgage rates. You look across the country and see 1% annual home price growth for July. So if you look at in real terms and compare that to income growth, should see some effectively real declines in home prices in economists speak. So from all of those standpoints, some modest improvement. Now, it's going to take some time before home affordability is back to what I would consider normal levels, right? If you look at a 35-year average or a 40-year average for home affordability, it's going to take some time before we get back to those levels, right? If you look at what it would take from an interest rate perspective alone, it would take mortgage rates in the 4.2% range to bring us back into balance. That's just very, very unlikely to happen over the next 12 months. And so we're likely to remain above average in terms of monthly outlay, the share of your income needed to buy a home. That's likely to remain well above long run averages here over the next 12 months. But the baseline is modest improvement. At least the needle's moving in the right direction now. Compared to where we were 3 or 4 years ago, where that pressure kept building. So needle moving in the right direction, still unaffordable from a historical perspective, but at least moving in the right direction there.
Some incremental improvement. Well, that's good. The negative equity. Those of us who have been around the business a long time always kind of keep our antenna up about what's going on in negative equity. Is it rising? And if so, and what are some things to watch for? What do we need to be thinking about there?
Yeah, modest increases in negative equity, obviously, or centered around some of these areas where you've seen softer home price dynamics, your Austins and your Cape Coral. So if we look at the number nationally, it's about 1% of homeowners that have a mortgage that owe more on their combined mortgages than their home is worth. That's historically pretty low, right? A historical baseline would be closer to 1.5%, 1.6%. So pretty low overall. There are some markets where, to your point, your antennas are starting to come up a little bit, right? So Austin, home prices have come down 20% from their peaks. You get into the Gulf Coast of Florida, prices in some areas 10 to 15% off of where they've been in recent years. And those negative equity rates in those areas are 5 to 8%. Still not terrible, right? Back in the great financial crisis era, you were seeing over 25% of homes nationwide that were underwater. So still not atrocious, but something that we're certainly keeping our eyes closely on. And again, it's those downstream. Do you see a corresponding rise in mortgage default activity in those areas? Do you see borrowers changing behavior? Do you see foreclosure activity in that contagion and catalytic environment where that negative equity results in defaults, and then those defaults are bought back by the bank or they're short sales, and then you see distress sales that can further pull home prices down? Do you see that type of behavior taking place? And then when we start to dig into the weeds there, what you do see is a little bit of elevated delinquency rates, certainly in Florida, right? And a lot of that has to do with the fallout from the hurricane season last year and just some lingering effects there. Sure. So there is some serious delinquency activity there. We haven't seen it manifest in terms of material foreclosure activity that could be pulling distress sales in there and having an added effect to home prices. But those are the areas, right? Your Texas and Florida that have seen the deepest price decline so far. Those are the things that we're watching out for. No major signs of concern yet, but you do have that first step of more meaningful volumes of negative equity in those particular areas, especially among folks that bought in 2022 and 2023.
All right. All the more reason to keep watching the report. Andy, what's one thing, like if there's something that was kind of under the radar, it's on the report, but it's a little bit under the radar, maybe people aren't dialed into it closely. What's something that you would recommend people just sort of watch out for, and why? Why would it be important?
Maybe I'll tweak that a little bit and say,
Okay.
what's the one that I watch most closely every month? Like, what's the most important one to me, and
What
maybe
do
the
you
most
watch?
impactful? And I think it's inventory right now, right? That's the one where those numbers will come out every month, and I'm curious because it could go either way right now. And you're seeing this push-pull behavior between buyers and sellers out there in the market, and it's got us in this finger trap from a price perspective where you start to see the market soften up, you start to see inventory grow. And then over the last 2 months in June and July, sellers in some of these markets have said, no, thanks, right? Thanks, but no thanks. We're just going to pull our homes off, and we're just not willing to accept a lower price than we're comfortable with for our home. And so it's really interesting to watch that inventory dynamic, where that's taking place, what that's doing to overall inventories, because again, inventory has been the key to price in recent months and recent years. And so if sellers pull back, that can firm up price dynamics. So I think that to me is maybe the most interesting to watch, not only at a national level, but what's happening in all of these submarkets across the country, and how are sellers behaving. And again, we're kind of caught in this weird anomaly where sellers control the market, right? And without a meaningful economic shift, without a job loss, recessionary environment where folks are maybe forced to take less than they really want to on a home sale, sellers still control the market. Even in some of these areas that have moved into oversupply, they're able to shift and kind of regain that control. So that's an interesting one to me. And then all of the delinquency trends, right? What's happening month over month? What's happening in sub products? What are you seeing in terms of those delinquency rate movements? And what's that telling us about stress among mortgage holders? Those are the two that I'm always interested in keeping the closest eye on each month.
That's good. Thanks for sharing those. Lastly, I'm just thinking, here we are, sort of the backstretch of 2025. What would be one word you would use to summarize what you expect for the remainder of this year anyway?
Yeah, I'm going to borrow a second word and say modest improvement, right? I think
modest improvement.
Regardless of the trend I look at, right, whether it's interest rate movement, whether it's improvement in affordability, whether it's improvement in lending outlooks, whether it's inventory dynamics in the way that those are shifting, and whether it's home prices, right, all of these metrics, or at least the vast majority of them, are moving in the direction you want them to move. They're just moving relatively slowly. And I think that's okay in today's market, right? We're in this weird position where we all want lower interest rates. And if interest rates moved 1% lower overnight, lenders would love it, right? It would increase volume out there in the market, but that doesn't solve the long-term problem, because what would happen is rates would fall, you'd increase demand out there, you'd buy down inventory again, and your prices would increase. And we'd eventually be stuck in the same affordability challenge we are right now. And so we need things to move somewhat slowly. Put on my lens of what's good for the long-term health of the housing market and long-term home affordability. You need time for this inventory to build so that when rates do fall, you don't overpower the inventory you have out there and create a longer lasting problem. When I look over the next year forward, anything could happen, right? We're in a somewhat of an uncertain economic environment, and you could see things shift tomorrow, and this podcast goes by the wayside. Most certainly, but baseline outlook is modest improvement out there. Maybe some delinquency rate increases. They're manageable. They're not overly concerning right now, barring a shift in unemployment. Interest rate expectations is for some modest improvement, which could lead to a little bit better lending volumes and slightly better affordability. So yeah, again, modest improvement is kind of the expectation as we move forward here.
Well, I have to say, given where we've been lately, modest improvement is music to my ears.
Right?
I'll take it. Yeah, we absolutely will. Thank you for covering everything that you cover. We're going to point people out to where they can get the report, and especially the charts and graphs that you guys put in there are just invaluable. It is a tricky time. It's a confusing time. So thanks for helping us shape up how we should be thinking about it and what we should be looking for. We really appreciate you.
You bet. Appreciate you having me.
Well, Andy, thank you for joining us and for sharing your insights from this month's Mortgage Monitor. We certainly live in interesting times, so thanks for helping us chart our path through it. Listeners, for those of you who want to explore the full charts, tables, and in-depth analysis, you can find the Mortgage Monitor on ICE Mortgage Technology's website, but we've linked that for you in today's show notes so you can get to it easily. So this has been Keys to Real Estate. I'm Mary Schuster for October Research, where knowledge is the competitive advantage. And thanks for listening. We'll see you next time.